Hello everybody, and welcome to our live market discussion, our fall market forecast. I'm Iman Bakadari from the Bakadari team at Douglas Elliman Real Estate. I'm very excited to be here with my esteemed colleague, Gabrielle Correo from the Bakadari team as well. And we have our superstar guest speaker here, Jonathan Miller. Hi, Jonathan. How are
Hey,
you?
great to be here.
Good to see you. Gabrielle, do you want to give a little background on Jonathan?
Yeah, it would be my pleasure to. So, Jonathan has been called many things over his nearly 40 years in New York City real estate: the go to expert, the market guru, and data whisperer, and our personal favorite, the DJ Khaled of real estate.
I love that.
He's the president and CEO of Miller Samuel Inc. It's a real estate appraisal and consulting firm that he co-founded with his family in 1986. And since he and the firm began issuing more than 200 reports a year on a number of U.S. sales and rental markets on behalf of Douglas Elliman, Miller has become known as the unfailing integrity of his firm's market analysis.
So, Jonathan, let's just dive right into the burning question that's been on everyone's minds. We are basically now at a point where the Fed is about to reduce rates, is what we're hoping. So, if the Fed reduces rates in their September meeting, what would be the ramifications on the New York real estate market?
Well, first of all, the change has really been pretty quick. I mean, we were sort of a few months ago, we were hoping for one cut in September of 25 basis points, which I think would yield an outsized reaction. People have been waiting 2.5 years for lower rates. Now we had, and it's over my pay grade to understand, but we had this Japanese yen carry trade, financial turmoil in the beginning of August, and it made everybody in the US look at the economy and say, hey, maybe we're going to go into a recession, or maybe things are getting weaker faster than we realize. And all of a sudden, the Fed is talking about 250 basis cuts, one in September, one in November, maybe 25 in December. So I think that's backed off a little bit, but it seems at a minimum, we're probably looking at 325 basis point cuts through the end of 2024. And the burning question is, what does that do? Well, the first thing it does, that'll make mortgage rates go down.
Mhm.
Right now, rates at the time of this broadcast are in the sort of just below the mid sixes for a 30-year. And the expectation is that we're going to see rates fall further. They've been falling for the last month without any cuts. And so we anticipate more cuts. What does that mean? I think that brings in more inventory into the market. Not a dramatic amount, but I think it brings in more supply. But at the same time, it brings in more demand. So when you look at housing markets, like Manhattan isn't devoid of inventories, you probably know, like the suburbs are, which are just very little supply, to the point where we're seeing bidding wars in 30 to 50% of the transactions out in the burbs.
The other thing on everyone's minds that we all want to know is, how will the upcoming election affect buying and selling?
Well, the way I look at it is, I went back to 1990 through today, and I looked at the co-op market only because the condo market is a blend of resales and new development. And new development closings generally have nothing to do with the time of the market. It's when the building is finished or the C of O is delivered. And so I just wanted to look at a pure resale market. So I looked at co-ops, which are 3 times more transactions than condos. And basically if you look at the market by even and odd years, an even year being a federal election year, whether it's the midterms or the presidential election, versus the odd year, which is, the in-between year, and we're in an even, federal election year, that what we tend to see is starting around the 4th of July, and I'm going to point out that this isn't holding up for 2024, but generally the pattern is sales are diminished from 4th of July roughly through election day, that they're disproportionately lower than they would be the same time in the odd year. And we don't see any impact in price. We don't see any impact depending on the party or the candidate. We just see a little bit of a pullback in transactions. And then after the election, there's this release for the next 3-4 months, sort of catching up to where it should normally be. And normally that's the way I would think of this happening, but we're actually seeing in July and August in our new signed contract reports that we do for Douglas Elliman, we've seen 2 big months of year-over-year growth. In July and August, we've seen 30 to 40% year-over-year growth in new signed contracts. And it's important to distinguish what a new signed contract means. So in our August report that was released today as of this recording, that it means contracts that were signed in August. It's not something that was signed in May and hasn't closed yet, so it's still under contract. Literally, contracts that were signed in the month of August are up 30 to 40%, depending on the property type. And that happened in the prior month too. So it's essentially showing that the summer, while there's usually a lull, especially in an election year, doesn't seem to be happening. It seems like there's a wake up from a 2.5-year slumber starting to happen.
So Jonathan, I have clients that are coming to me and complaining that they've tried to buy in Westchester and the suburbs, and they just had the worst time. And so they've resorted to buying in Manhattan, which was not their first choice, but they're finding it to be a lot more feasible to do so. So I was just wondering what your take is on, sort of the Manhattan market compared to the suburbs, the market in the suburbs.
Yeah, that's such an interesting situation, because the suburban markets, not to go too far down the rabbit hole, but Manhattan was late to the party during COVID. Manhattan was about 9 months behind the suburbs. And so when the Fed began changing policy to raise rates in the early part of 22, it interrupted the Manhattan boom. And so inventory wasn't wiped off the face of the earth like it was in the suburban markets. And so as a result, because the Fed kept rates too low for too long, this is a US housing condition. Manhattan is one of the few markets, because it was sort of late to the boom for many reasons. We're seeing bidding wars in the suburbs like Westchester, Fairfield County, Nassau County, some in the neighborhood of 30 to 45, even 50%, depending on the submarket, of the transactions that have been closing are selling above the last asking price. When I say bidding war, that's my proxy for somebody that closes higher than what the seller was asking. Mm-hmm. And they're doing that out of desperation. They're doing that because there isn't product to look at. And that's one of the advantages Manhattan has as a market right now, going into what I think is going to be a pretty active remainder of 2024.
And then my other question for you was, I'm finding the rental market to be pretty active. So I was wondering what your take is on the rental market right now in Manhattan.
First of all, the way to think about rentals in the context of the sales market and mortgage rates is think of them as competition. So what has happened is the rental market's always been relatively tight, but then we've gone through this 2.5-year period of mortgage rates rising at their steepest ascent in more than 40 years. What that has done is tipped people that would be buyers into the rental market, which has made a very challenging situation for renters too. And the way to think about this period we're going into now with lower rates, and let's be clear, rates are not going to be anywhere near as low as they were during the pandemic. That's not something to expect, and nor do we want that, because otherwise we get this crazy up and down seesaw effect of rates being too low. And then, essentially the fact that rates have been, what you're actually doing, and it's something that I don't think people appreciate, is that when mortgage rates are too low for too long, they make housing less affordable because you obliterate inventory. Inventory is this organic process. Forget new construction, but just in the existing inventory is 90% of supply, and that's this living, breathing sort of organism that takes time. When you wipe it clean, it just takes a long time to come back, and that's what's happening. So I'll give you an example. You can see, this is not the New York metro area, but like, for example, in Miami, just because I was just looking at this the other day, inventory is up like 40% year over year.
Wow.
But it's 50% below pre-pandemic levels. So inventory is still low, But when you look at the number by itself and say inventory's up, I want to say Westchester's up like 15, 20%, but it's off of record lows. It's like going from 1 to 2 is 100% increase, but it's still only one more listing, right? I mean, it's the percentages really get sort of distorted. And the bottom line is that think of as mortgage rates drift lower, which is the current thinking, over the next year or two, rents will either stop rising or level off or even decline depending on the submarket you're looking at. So there is relief coming for renters, but we're not expecting a correction in rents where there's a huge discount coming. It's not going to be setting records every month the way it has been for the last couple of years.
Do you feel that this rental trend that you've been tracking of the surge in prices is across all the price points?
Yes. So what we're seeing, whether you're looking at studios, 1 bedrooms, 2 bedrooms, 3 or more bedrooms, which is how we break it up, whether you're looking at doorman buildings, non-doorman buildings, existing product, new construction, rents have been rising across the board, across the market is the way to think of it. It's been tight all around. And I think universally, the impact initially was more significant on the starter market, the smaller apartments, but basically everything has sort of become, challenged as a result of rates.
So it's interesting because it feels like the high interest rates have caused people not to want to trade out of their low interest rate purchases into the current interest rate purchases, which is choking off supply, and it's causing the rental market. People are basically not moving, right? So
Right.
Do you feel that's another factor?
Absolutely. That's called the lock-in effect. And what that means is that people, they bought a house or refinanced during the sort of pandemic era when rates were on the floor, and they're sitting on a 2.75 30-year fix. And if they become a buyer, it's 6.3.
Right.
So they're not in a hurry. But I use this example all the time just to sort of exaggerate. That couple that bought a 1-bedroom condo that had triplets 2.5 years ago, and they can afford something bigger, but they're waiting for rates to come down. Life continues to move on regardless of where rates are going. And their resolve to sit still is weakening as rates come down. Sort of the spread between that 2.75 or 3% or 4% mortgage and the prevailing rate, as that narrows, more people come into the market. The other way to think about this is that we're not expecting prices to come down. Normally what happens is when you have a slowdown in activity, you have inventory pile up, and that really hasn't happened. And the reason it hasn't happened is because everybody's just waiting for better conditions. So they're not putting their home on the market. So we didn't have that surge in supply,
Right.
supply piling to the sky.
Sure.
Because that's where you get price cuts, right? That's where you have more competition, more listings.
Right.
So pricing comes down. Certainly pricing is not as high or elevated across the market as it was in 2021, but it's more of an adjustment as opposed to a correction. And I think that inventory is going to still have a lot of challenges to get ahead of falling rates and higher demand,
Right.
to really soften prices in a meaningful way. In fact, nationally, across most of the markets that we look at, and then markets I follow for fun just because I have nothing better to do. I'm a dull and boring numbers guy. Is this idea that I think housing prices generally in the U.S. are going to edge higher for the next couple of years, especially when you consider that the falling or the expected decline in rates is probably, economists are anticipating a couple of years of this.
Right.
So if you're sitting today, 2 years, and then you go through time, and 2 years from today, interest rates will be lower. They won't be at record lows, but they'll be lower than they are today. So even people that are looking at the market now will probably have the option to refi at a lower rate before prices rise. Inventory is the most important metric in housing today, and inventory is not behaving the way it normally has because rates went up so quickly that the Fed has essentially created this massive distortion in the housing market.
It's so fascinating how the relationship between the mortgage rates and the inventory kind of correlates
Yes.
with one another. Do you feel that the rate change is going to be dramatic enough that's going to cause major movement in the market, or do you think it's just going to be like a softer kind of like, you know what I mean? Like, what do you think is
Right?
Because it doesn't. I don't think it's going to move the needle that much. It's not going to make rates that were unaffordable again to a great
Oh
extent.
no, we can predict where rates are going to go all day long.
Right, yeah, of course.
But the idea here is that rates are going to be lower than they are today over the next couple of years, but they're probably not going to approach anywhere near where they were, 2.75%, 3-4%. They're going to go below 6. My gut, based on nothing but experience, is that rates are probably going to end up settling in the mid 5s.
Oh,
And I was saying that during the pandemic, that's where rates need to be
I remember
so
that,
we
yeah.
don't get these massive swings in supply and demand. I think it's it's more advantageous to participants in the market. It makes housing less scary, subject to all these big swings.
So let's say you're one of these owners or sellers that is becoming less and less able to hold, right?
Right.
When would you think is a good time for them to consider putting their property on the market in the next year?
So I guess my simple answer is sooner than later. And the reason I'm saying that is because there's going to be an acceleration of demand. So if you're wait too long, there's going to be more supply that's going to come on. You're going to have more competition. My thing is get going. If you're thinking about getting into the market, there doesn't seem to be safety in waiting anymore.
So the same owner, let's say they've been renting out that apartment for the past few years since the pandemic. Is there still a good outlook for them to continue renting and getting those prices? I mean, we've been seeing, as you know, exceptional numbers for rentals in the past few years. So can these landlords who own maybe one apartment or a couple of apartments in New York still expect to be able to charge the same rents to the tenants that they have there?
So as rates continue to fall, the answer is that's going to be more and more difficult. It doesn't mean like a correction in rents. Listen, rents right now are in Manhattan alone are about $100 below the all-time high that was set last summer. So my guess is, if you're doing a renewal now, it's probably you would achieve the same or maybe even a little bit less, slightly less than you did a year ago. That the market is topping out.
Jonathan, can you speak a little bit about the state of the foreign buyer? Because that's a very big market for Manhattan. We're an international destination. People love coming to New York. They feel New York is a great place to own real estate. And how are you seeing that these days?
So I still think that the international demand for the last 4 or 5 years has been largely absent. In Manhattan specifically, they comprise international buyers, that is, comprise about 15% of total demand. And that's heavily weighted in the condo and single family and not in the co-op market. But the dollar has been so strong. Like there isn't the massive discount that there was 7-8 years ago. So I would say, there's still international interest, international demand, but until we see the dollar weaken, which I can't think of why that would happen soon, that they're still going to be a light participant in the market.
Wow, Jonathan, I could spend all day with you chatting about the market. It's so stimulating to hear your take. What I wanted to say was Jonathan has an incredible newsletter
Housing Notes.
Called Housing Notes. And I read this, cover to cover every time, and he sends out so much great content. And he also has an incredible blog called Matrix by Miller Samuels. So if you would like to be an expert on the Manhattan market, I highly, highly recommend you sign up for his newsletter and you read his blog, and that way you can be an insider in the New York market.
Thank you.
I'd like to take this opportunity to thank Jonathan for this incredible discussion. Gabrielle, thank you so much for joining us today.
It's great.
It's been an incredible 30 minutes, and hopefully we'll see you again. That would be great.
I have about 21 years left on my mortgage, so I'm going to be around for a while.
Thank you, John. Thank you. And thank you all for watching. Thank you so much.
Thank you.